Good evening, friends. Thank you for taking the time to participate in this value investing forum. I wear two hats when I make this presentation today. Over the last 25 years, I have seen the investment business very closely, the sell side and the buy side. The sell side is basically the brokerages who are supposed to specialize in sectors, who are supposed to have high IQs, who are supposed to come up with ideas every day and throw them at the buy side, which is the fund managers, the asset management companies, the FIIs, mutual funds, insurance companies. And while the two businesses are very connected, there are significant differences that I've observed between the two sides. There is one side which is which comes up with an idea of the day, a theme of the week, a strategy for the quarter, and the objective is to then channelize the sales force to push those ideas to the buy side. The job of the buy side is to hone an investment philosophy over a period of time and then execute it through a process of stock selection. And what we've observed is that while investment is an amalgam of IQ and temperament, it is non-compromisable that you have IQ in sell side, and it is equally non-compromisable that you have temperament in the buy side. You can get your IQ from the sell side, you can get sector knowledge from the sell side, but basically the discipline, the rationality of becoming greedy when others are fearful and becoming fearful when others are greedy is something which is easier said than done in real life, in real practice. So what I'll do is basically split this presentation into two parts, make a quick case for equities, and I saw many of you raising their hands, 75% plus invested in equities, pretty good. And then a quick case for India, which will include what the FIs feel, what the sell side feels, etc., etc. And I'll try and use the buy side hat when I'm presenting the case for equities, and try and use the sell side hat when I'm presenting the case for India. So basically, I start by what is investing basically. The problem of anybody with wealth or with money is to preserve that wealth from the corrosion of inflation, and if possible, to actually augment the purchasing power of that wealth. If you did nothing in your life, then this 100 rupees of 1979 would be able to buy just 5 rupees worth of goods in 2015, right? So 95% of the value would have got eroded. If you bought fixed deposits, right, then the 100 rupees would just about be able to buy 100 rupees of purchasing power today. You have postponed your consumption from 1979 to 2015, right? 35 years of postponement of consumption, and you're just able to buy as much as you could buy 35 years ago. So pretty bad way to invest, and the dominant way to invest in India today, right? By far, most of the wealth is invested this way. They are basically lending you their current consumption. You can enjoy that consumption and give it back to them, with the same purchasing power 10 years, 20 years, 30 years later. Gold does slightly better job, but over a 35-year period, you double your purchasing power. On the other hand, you have equities, which has increased your purchasing power by nearly 15x over the course of this 35-year period. So basically, equities has delivered the best returns over any period of time that you want to take, right? You have bonds giving you 100 rupees multiplying 18 times. You have gold multiplying by 38 times, and you have equities including dividends multiplying by nearly 500 times. So there is absolutely no contest between equities versus gold versus a fixed deposit, and you still have the largest asset class in India being bank deposits today, and not being equities today. So that's the first part of this why equities. The second part is that if you see all these balloons here on the slide, between 2007 and 2015, we've had so many exciting things happening in the world, right? Bear Stearns folded up, Lehman folded up, Merrill Lynch almost folded up because it got merged with another entity. We had pigs, Portuguese, Ireland, Greece, Spain. We had taper tantrum. How many of you have read about these things? Can you please raise your hands? Yeah, so everybody is well read, everybody's read a lot of articles, understood a lot of things. If you read everything about all of this, right, you would have, all of these are negative, balloons there, right? What has happened to the markets in the course of all of these developments? A 15,000 Sensex in the midst of all of this has become 30,000. So basically, each of these development would have pushed you out of the market, would have made you time the market, would have stopped your time into the equities, right? Because they are all scary developments. Basically, the point I'm trying to make is that if you divide all that is available, all that is thrown at you between, that you can, that which is important and that which is not, all the macro that you saw there is basically knowable in the newspaper when you wake up or on the news channel before you go to bed, but not important to making money, right? You knew all of those macro, you could have become a PhD in each one of them, but you would have missed the ride from 15,000 to 30,000. But if you got your micro right, if you got your understanding of the companies right, then you could have ridden that 15 to 30, possibly even more, right? So basically, the first point that I wanted to make was that there is no contest between equities and any other asset class. The second point that I want to make is that most of us spend 80, 70, 60, 50, whatever percent of our time trying to read about things that are not important to money making, right? And in the process, missing out on what is relevant as is to corrode that ability to preserve your purchasing power. I'm most excited by this concept. The most powerful concept of finance is that a dollar saved today should grow to not more dollars, should grow to be worth more dollars, meaning purchasing power should be more. Buffett, if you read his annual report several years ago, he used to talk about investing means preserving your purchasing power. I think he too has changed that definition over a period of time to augmentation of purchasing power. There's another interesting quote which says the greatest shortcoming of human race is our inability to understand the exponential function. This is the last line is something that is news to me. Most of us feel that 50 is old enough to make any worthwhile contribution to the society, to life. Warren Buffett is worth $66 billion. At the age of 50, he was worth $300 million. At the age of 60, he was still not worth $1 billion, and he's worth $66 billion today. So that brings us to the most important concept, the eighth wonder, as Albert Einstein called it, called compound interest. Basically, he said, he who understands it earns it, and those who don't pay it. So basically, levered individuals, levered companies, the path is only one way to disaster. Avoid companies with leverage, except maybe the financial services companies or banks. But basically, we all know that a 8% compounded return on fixed deposit, maybe 15 years out, could be 3.2 times your money. If you invested in index or a passive fund, that 3.2 times in 15 years would probably become 8 times or 11 times, depending on what the returns are. If you invested in one of our schemes 15 years ago, value, that would be 28 times up. So the case for equities, the case for equities as an asset class, the case for time in is rested, is quite clear. What confounds me is that, an iShare, which is 200 rupees 10 years back, 2,000 rupees a few years back, 20,000 rupees a few months back, when you bet on a good stock, it can go up 10 times, it can go up 100 times. So a 200 rupee iShare can make you 2,000 rupees or maybe 20,000 rupees. But if Siddharth Lal goes bonkers and the company goes bust, you lose 200 rupees, right? So why is it that we are so fearful about that loss of 200 rupees and so less excited about that gain of 2,000 or 20,000 rupees? Basically, behavioral finance suggests that the pain of that 200 rupees loss is usually much greater than the pleasure of that 20,000 rupees. I mean, let me give you a more simpler example. Why is so much money into bank deposits and not into equities? Because a bank deposit holder sees a new high in his net worth every day. The meter of interest ticks every day. So every day you are richer by a little bit. And at the end of the year, you are richer by 8%. But equities doesn't make a new high every single day, 365 days a year. It probably makes a new high 10 times, 20 times, 30 times in a year. But it compounds at 15, 20, 25% depending on whether you are a passive or an active manager. But the pain on the other 350 days or 300 days that it is not making a new high is so high that even if the end game is a 15%, even if the end game is 20%, it doesn't matter. I mean, this table of compounding is available to everybody. The historical return on various asset classes is available to everybody. What is unbelievable still is that it is still not the most popular asset class. So that's my simple case for equities. I'll now go on to my case for India. So basically, I'll divide that presentation into 5 parts. You've heard the QGLP philosophy of Motilal Oswal many times. Applying that to India, I think we have everything in place today, barring G, which is missing. And I'm going to talk about G towards the end of this presentation in terms of what is our outlook for G, so that completes the QGLP for India. So, firstly talking about, India macro, I haven't seen India in a position like this for 10, 20, 30 years. Our fiscal deficit is budgeted at 3.5%. This is the biggest, by the way. How was the budget? How do the foreigners see the budget? I was asked to speak about that. Well, if we had 3 or 4 or 5 SOPs here and there for 4 or 5 companies and those stocks would have gone up, that wouldn't have mattered to the foreign investors. What really mattered to the foreign investors was the fiscal deficit, and I think they got that right. Basically, they committed the FRBM, the Fiscal Responsibility Bill, committed to a certain target, and the finance minister respected that target. So so you saw the biggest bond rally, right? And that is the biggest risk. I mean, FIs have been selling equities for a pretty long time. But if currency or bond market of any country has a question mark, then that country becomes a basket case. And we've seen that in Latin America, we've seen that with Brazil, we've seen that with a few other countries. So basically, I think the biggest achievement of the budget, and for which I give a very high mark out of 5, like 8 on 10, 9 on 10, is basically that he stuck to the fiscal deficit target. Current account deficit, how many of you have seen a sub 1% number ever in your life? And by the way, this quarter ending March, we may likely have a first current account surplus in a very, very long time. Inflation, we are down to sub 5% consumer price inflation index, and my economist tells me that if we had a bad monsoon this year, if India had a bad monsoon, then we should end up with about 5.5% consumer price inflation index. So what does killing of inflation or curbing inflation mean? It basically means that the durability of your growth or of your upcycle will be a lot longer. That is what you are paving the way for. As far as the forex reserves are concerned, we are again in a very healthy position, and that is why our currency is one of the best performing in the world. So what is really missing in India, in this whole India story, is the G factor. So if you look at GDP growth, if you look at industrial growth, if you look at capex in India, I mean, we haven't seen a deflation in India, i.e. prices deflating the GDP of our country ever in the last 40 years. So these are unprecedented times. I mean, this can make any hero like Modi look like zero, because you have so many factors that are dragging him down, which are beyond his control, that your assessment about Mr. Modi itself could go wrong when you have so many things detracting, the growth rate of a country. Looking at the government's, report card, I think they've done an absolutely fabulous job. I talked about controlling inflation, lowering subsidies, huge step up in investments at a time when revenue growth is weak in the country. So we have 40, 50, 60% growth across most of the infrastructure sectors. Turning to FDI, we had $20 billion FDI in FY14, we had $30 billion FDI in FY15, and we'll likely end with another $10 billion increment in FDI in the current year. So basically 20 becoming 30 becoming $40 billion, and now we have the Uday scheme, which should hopefully solve the problem of the power sector. So we believe that this is a once in a lifetime leadership change. The problem with this leadership change is that it has come along with God wishing 2 bad monsoons on Mr. Modi, the world slowing down, and he inheriting 5 really bad years of performance of the previous government. Now to overcome that setback is going to take time, and we are all impatient as a country, impatient as investors. We want to see instant gratification. We are not seeing the results. The GDP growth is not happening. So what if there is drought? So what if the world is slowing down? So what if you have a baggage of 5 years of bad performance? So at least we remain very hopeful of the impact, the long-term impact of the positive initiatives, the initiatives taken by the Modi government. And then turning to RBI, the entire emerging market is in a mess today. Every currency is collapsing. We've been an oasis of stability in the currency market in the world. Real effective exchange rate has actually appreciated ever since Rajan has come back, and we are hoping for a potentially 100 basis points cut in interest rates over the course of the next 12 months time, possibly 25 basis points or even more by the 5th of April itself. So we have excellent macro. We have a great Prime Minister in place who's doing all the right things from a long-term perspective. We have one of the most qualified person to head the central bank of the country. We heard that he could potentially head Fed or ECB. Very few people of that credentials, at least within the government or the institutions of India. Turning to the next part, which is the corporate sector. So what has happened to the corporate sector? Basically, cyclicals have got killed everywhere. Every market, domestic cyclicals, global cyclicals, metal sector profits down 85%. PSU bank profits down 60% from their highs. Capital goods profits down 50%. Cement profits down 33%. But luckily, India is no Brazil. India is no Indonesia. India has a lot of diversity in its corporate sector. So during this period when you had 30, 40, 50, 80% collapse in earnings, you had some sectors which have continued to march ahead year after year. You have the consumer sector, you have a healthcare sector, you have a technology sector, and you have the private sector banks. Each one of these sectors have continued to march ahead year after year to offset, to more than offset the drag down in earnings of the Indian corporate sector by the earlier sectors that I mentioned to you, basically the global and the domestic cyclicals. Look at this. I mean, cyclicals used to contribute to 43% of the earnings of India. Global cyclicals used to contribute to 43% of the earnings of India. They now contribute to a mere 19% of the earnings. I'm going to show you the PE chart of India. It looked like we are at the average PE. We are at the average PE. But commodities, which contributed 45%, now contribute 19%. And technology, healthcare, private banks, which used to contribute a lot less, now contribute. So the quality of the earnings have improved, but the P's are at their averages. So what has happened to the corporate profit of India as a proportion of the GDP? This number has nearly halved. We used to be at 4% in 2004. A lot of momentum in the global economy, in commodity prices, took it up all the way to 8%. And this year, ending March 16, we are going to make a new low of 3.9% corporate profit to GDP. We haven't seen this number in a very, very long time. What has happened to corporate profit margins? The corporate profit margins, profit after tax margins, which used to be as high as 17%, are down to 11% in this year. And valuations are at their averages. So margins are at their low, quality of earnings have significantly improved, but valuations are nearly at their averages. P is about 1 point lower than what you've seen in the last 10 years. India's contribution to the world market cap, which used to be as high as 3.3%, has come down to 2.2% now. It has averaged at this number. So with a great leadership at the central bank, with the great leadership at the government, with quality of earnings improving, with the world looking like not such a great place right now, India's market cap as a proportion of the global market cap is just about the same that it has been in the last 10 years. here's a little thing that answers the question that many people have in mind. Why are FIs selling India? They've been buying India when it was not looking so good. India is today an oasis, right? So why is India being sold by the foreign investors? Basically, Indian corporate earnings have disappointed. Indian analysts have also disappointed all the foreign institutional investors. The sell side has honestly disappointed the buy side. We go with our presentations at the beginning of every year. We tell them, hey, listen, 20-25% growth done hai, ho jayega. And then what happens? So 2014, 2015, 2016, these guys listened to us. Every year they used to listen to us. They jacked up our valuation. So India's PE, if you see the right side bottom chart, India's PE within the emerging markets saw a huge expansion. Our PE became nearly 2x of the emerging market PE. So, we like to call this the golden triangle. Highest downgrades of India within the emerging markets, highest valuations, and India was 2x weight, so highest overweight. Now imagine the state of that fund manager who listened to us, put double the weight of the emerging markets on India, took the valuations up, and then you saw the downgrades in earnings. So basically this kind of explains to you why FIs have sold India. Basically, they've got disappointed with the collapse in the earnings of domestic cyclicals and the global cyclicals, and that in turn has caused underperformance of the Indian markets as well. So now I'll just quickly I've shown you the corporate profit to GDP, the corporate profit margin chart. 2 years back I showed you certain slides. I'm just going to quickly crystal ball gaze here to see what is the case for India. We discussed the case for equities earlier. What is the case for India? So this is a chart that you must have seen in many of our presentations earlier. The linear growth in GDP presents many non-linear investment opportunities. We took 58 years to earn the first $1 trillion of GDP, and then in a matter of 7 years we earned the second $1 trillion, and 5 years and 3 years for the third and the $4 trillion. All that is very important, but from the global investors' viewpoint, India was a mere part of emerging markets. India was just an allocation within emerging markets, right? As long as you are an allocation within the emerging market, your company decides your fate. So if emerging markets look ugly and emerging markets have redemptions, then you sell India also, right? We believe, and what I hear from a lot of our clients is that all of them have Morgan Stanley Emerging Market Fund, JP Morgan Emerging Market Fund. Many of them have emerging market funds which are very big and are seeing redemptions now, because of which you are seeing selling in India as well. There is a possibility, as you clock these next $1 trillion numbers, to become maybe the 4th or the 5th largest country in the world over the next 7 or 8 years by 2023, there's a possibility that India will now emerge as an asset class within itself, by itself, like emerging market is an asset class. So the fortunes of India are deciding the flows of India, inflows as well as outflows. So if fortunes of India decay, then there will be outflow. Fortunes of India improve, there will be inflow. So basically we are, in my personal view, at the cusp of emerging as an asset class, and over the course of the next 1 or 2 years, 2016-17 calendar, you will likely see meaningful investments coming into India because of India as an asset class, not India being a part of the emerging market. So decoupled from this whole emerging market linkage. In the meantime, even more exciting and a certain story is that of Indian savings. So here's an interesting chart which will show you how money has got channelized into equities. So if you go back, you see those boxes at top, that shows you what proportion of all the financial savings got channelized into equities through mutual funds and insurance companies. So this number used to be as high as 6, 12 and 10% in FY 7, 8 and 9, right? Has come back for the first time after negative flows in FY 16. So in FY 16 we are likely to see nearly $13-14 billion of investment in equities from domestic financial savings, which is nearly 8% of the financial savings of India. Even if you take about 6% of Indian financial savings being channelized into equities over the next 2-3 years, this number itself could be a potentially a 12, 13, 15, 16 billion dollar inflow into equities per annum, which is as big, if not bigger, than what foreigners were pumping into India. So India becoming an emerging, India becoming an asset class in itself is another thing, but domestic flows itself could be quite exciting for India. This is the picture of the long-term, earnings growth. We've seen very high earnings growth rates back in 93 to 96. Earnings used to compound at 40%, and then we hit an air pocket of 7 years between 96 and 2003, where earnings grew by a mere 1%. Again, the 2003 to 8 upcycle, when earnings grew by a compounded 25%, and now we've seen 8 long years of 6% earnings growth versus our long-term earnings growth trajectory of 14%. We believe that the worst of the corporate profitability to GDP, the worst of corporate profit margins, the worst of corporate profit growth is behind us. So here's an interesting simulation that we've done. So you can see this corporate profit to GDP chart. The green part of the line shows you when economy was doing well, economy was an uptick, the world economy was doing okay. We had corporate profit to GDP rise from 4.7% in FY4 to 7.8% in FY8, and from there it has tumbled all the way down to 3.9%. Now let's make some very simplistic, realistic assumptions. Okay, I present to you two scenarios. The high of corporate profit to GDP is 7.8. The average for this entire period is 5.5. Okay, so we are presenting two scenarios here. Let's assume that corporate profit to GDP from 3.9% just about limps back over the next 4 years to its average of 5.5%. And the second scenario is an average plus scenario, which is the average of the high and the average, okay, which is a little more than the average. So let's assume that in the second scenario it goes up to 6.6%. So still below the highs. What happens to corporate earnings? What happens to corporate profitability? So this is what happens to the Sensex EPS number. The Sensex EPS number, which has been growing at 6% for the last 8 years, which has grown at 14% for the last 20 years, can, if we just limp back to our average of 5.5%, imply a 24% compounded growth from here. If it goes back to average plus, not the high, then that implies a growth of 33% compounded from here. And stocks are slaves of earnings. If this happens to earnings, then here's what can happen to the stocks in our view. So basically, if you assume that on the average corporate profit to GDP, you get just about average PE multiples. This is trailing PE multiple. So the trailing PE multiple of 17.5 times. Then today's 25,000 Sensex could easily be 55,000 by 2020. And if you take an average plus scenario, I think that's something which is really crazy. So today, to talk about an 80,000 Sensex, etc., will seem like a very emotional, kind of, an appeal or a call to come back to equities. But I think the magic of compounding, the historical performance of India, the average valuations, make it quite easy to imagine those kind of scenarios. I apply the same, sensitivity on another parameter, which is the corporate profit margin. So you've seen corporate profit margin high of 17.2%. This number has come down all the way to 11% by FY16. The average over that 15-year period is 14.3%. So if you were to just take 14.3% margin for the Indian corporate sector and assume that the sales growth of India will be as much as the nominal GDP growth of India, which is about 11-12%, then once again you're talking about a very similar outcome, which is about 25% EPS growth, Sensex EPS growth, if the corporate profit margins limp back to just the averages of 14.3%. But if they were to go back to 15.7, then you're talking about a much higher and unbelievable, corporate earnings growth. And that in turn translates into a similar, Sensex target over the next 3 to 4 years time. So this is really the case for India. We believe that the government is in place, the central bank is doing a good job, quality of earnings have improved. India could emerge as an asset class over the coming years. Domestic flows are likely to be quite strong. Corporate profitability is extremely depressed on every parameter that you may want to look at. Just reverting to the means, forget the highs, could present exciting investment opportunities. You can apply this to Nifty, you can apply this to, the whole analysis to the corporate profit to GDP, the corporate profit margin. More or less the results are very similar. A possible 20-25% earnings growth, a possible 25-30% market return, and so we believe that the future of the Indian markets, could be at least as exciting as the past. I mean, you've seen this in the past already, the 100 times in the last 30 years. We believe that in the next 4 years will be, as exciting, if not more exciting for the Indian markets. So, I mean, so that's the case for equities, that's the case for India. Basically check into equities, don't try to time the markets, work on how much time you spend in the markets or into equities. Thank you very much.